David Herro joins us now for more, the CIO at Harris Associates. David, wonderful to catch up with you, sir. Can we talk about the opportunity set beyond the Magnificent Seven into Europe and elsewhere?
Well, especially for investors like ourselves who focus on company-specific factors, valuation metrics, which is low price, high quality at Harris Oakmark, it's a really good set of opportunities outside the United States, particularly in Europe, where in essence you can find high quality businesses, 10, 11, 12 times earnings, sometimes 6, 7, 8 times earnings, yielding more than the price to earnings ratios, generating lots of cash, excess cash on balance sheets, free cash flow yields, low double digit. I mean, all these valuation metrics for us are just happy hunting grounds in essence. And
not just you, David. I'm going through some names. Novo Nordisk, GLP-1's a massive deal over the last 12 months. Everyone balled up on machines for chips, ASML, luxury players, LVMH. David, we've seen big moves in these markets. I want to be clear about that. As you know, the likes of the DAX and the Stocks 50 had brilliant years last year, just not as good as, say, the NASDAQ 100. David, can you describe the sectors, the kind of companies that you're focused on, if they're not these big headline-grabbing names of the last year or so?
Yeah, the headline-grabbing names are actually blinding investors from what's beneath those names. And take companies in Europe, the financial sector, major financial institutions like BNP in France, Intesa in Italy. These are companies that literally trade at 6, 7 times earnings, yield almost 10%, have excess cash, are buying back their shares at an aggressive amount. And everyone kind of forgets about these because they are being shielded or blinded by these theme stocks like the GLP-1s, like the semiconductor companies. Industrial is the same thing. If you look at the German premium automakers, BMW, Mercedes-Benz, both trade at about 4 or 5 times earnings and yield almost 10%, and again have so much excess cash on their balance sheets that they too are buying back shares. So these are the types of businesses no one seems interested in. No one is focused on cash flow and valuations, which to us provides an opportunity, because eventually we'll come down to earth and we'll look at what makes a business valuable, and that's the cash which it generates.
Eventually we'll come down to earth and people will stop buying ARM and piling in on the heels of their earnings, but maybe not yet. David, love speaking with you. I do want to go to BNP because there was an issue with Credit Suisse, and I know that that was sort of one stock that you got fully out of after being a heavy investor last March. What did you learn from that episode that colors your investments in European bank stocks today?
First of all, in any bank stocks, what you have to do is be able to price uncertainty in some of their businesses, because you don't have clear transparency into the assets of every single bank. What you have to rely upon is A, the accounting, and B, the reputation and the quality of the management team. What we got wrong with Credit Suisse was we believed that at some point they would be able to turn around their investment bank. The other 3 areas of the business did just fine through the cycle. The private bank, the asset management, the Swiss Universal Bank. All the strengths in those 3 businesses were blinded by the ineptitude of the investment bank. Our belief was that if they could turn that around, if they could fix that, the other 3 businesses, then the light would shine on the quality of the other 3 businesses. With a situation like a BNP, we don't have any need for a turnaround in any of their businesses. This has been historically extremely well-run company, a very good culture of risk, very good at growing. I think book value per share over the last 10 years has grown at over 7 or 8% per year. And today the company trades at just 2/3 book value. And like I said, it yields when you add in the stock buyback, it yields well into the double digits. So what you have to be careful and hope that they can fix something. Now, we finally sold out of Credit Suisse, started selling it at the end of 2022, because when they released their plan to restructure the investment bank, we thought it was an extremely faulty plan. So we thought, okay, after all this time, after all this hope, they're not going to be able to fix this. And by the way, the problems at the investment bank, as we know, by the end of 2022, were finally starting to drip into those other strong divisions.
David.
So this is one of the lessons. If there's a bad division, it might be bad for a reason, and sometimes you just have to assume it's irreparable.
Was it a one-off? And this is something that we keep kind of focusing on. Or do you see other issues, specific concerns in other banks, whether it's in Europe or the U.S., that haven't been fully identified?
Well, was it a one-off? It was a one-off, I believe, in the greater scheme of the European banking sector. But like any company in any region, they will run into problems. Silicon Valley Bank, I would almost argue, was a one-off because they were so irresponsible on duration matching. You know, it wasn't a credit quality issue. It was this duration matching with assets and liabilities. They were so irresponsible. But many banks aren't so irresponsible. So you can't, I never thought it was systematic. I do believe it was more of a one-off in the Silicon Valley Bank and the other regionals who got caught up with the same lack of risk control. Same thing in Europe. There's a company like Intesa, BNP, Allianz, these are Lloyd's. These are the financials we have that have never had major quality, compliance, risk issues. And this is what one has to look for, is the culture of risk control. Because in banks, this is number one. Risk is number one.
David, can we just finish by talking about your approach to investing? It was interesting. We caught up with Jim Zauter of Apollo in the previous hour. I'm not sure if you saw that conversation, but we were talking about passive investing over the last 10 years, just the explosion of it and the bigger getting even bigger, with money just sort of indiscriminately going into equity markets and going into the Magnificent Seven, like they have done over the last 12 months or so. David, how would you frame things? I'd like your opinion on it. Do you see passive investing as the enemy to the kind of thing that you do every single day? What use is it if you find a name that looks great on paper, but nobody else notices and the money never comes?
Passive investing is an active investor's friend. And I say this because the weight of money going into passive investing means that money is just being invested in businesses, in essence, because they are there. This creates inefficient pricing of assets. Now, in the short term, and maybe even the medium term, you listened to David Einhorn, I think, last week, great investor, but he talks about the challenges competing against these people. Because the weight of money moves into this, and the stocks, that market caps get bigger and bigger and bigger. I mean, it reminds me of this old idea called portfolio insurance. As the stock price goes up, you buy more of it. Well, when cars go up, you don't buy more cars. When apples go up, you don't buy more apples. So when the price of businesses goes up, it goes against economic fundamentals to buy more of them. So in the long term, this creates opportunity for active investors to exploit these market inefficiencies. We also look a bit more volatile because if we don't look like the index, we're varying versus the index. And sometimes our clients don't like that. But I think ultimately it creates market inefficiency, which is good for the active investor. But in the short term, it certainly isn't painless for us long-only, boring, value, bottoms-up investors, because we sometimes get kind of blown away by where the weight of money is going, where we may be invested where that weight of money is coming from, which means weakness where we're invested and strength where we're not.